André Kostolany shaped two generations of stock traders in Germany and is regarded as a true speculator. He lived to be 93 years old and had almost 80 years of stock market experience. In this video, you will learn 5 rules from the stock market legend for wealth building and how Kostolany managed to quadruple his money with one speculation. Enjoy the video. They claim even today that one should not rely too much on tips when speculating on the stock market. The notion that information is ruinous is completely wrong. Rule number 1: information ruination. This means that one should not chase after every stock tip, as every day the media heralds a new trend. Today, hydrogen stocks might be in vogue, and tomorrow it's video technology stocks. The problem with such stock tips is that often, the media reports on them after there have already been massive price jumps. Small investors then enter when the stocks are already highly valued, leading to price slumps and losses for the small investor. Therefore, information ruination means not jumping on every hype. People are notorious latecomers, and often the big returns have already been made. A current example is Plug Power stock in 2020. There was a huge hype about hydrogen stocks, further fueled by questionable stock newsletters. The result was moon prices for Plug Power with a price-to-sales ratio over 100. This means the annual turnover was 100 times smaller than the market value. At the peak of the hype, the price was over 60 euros on January 26th, and the greatest media attention for the company was exactly around that time. A good indicator for this is Google Trends. Searching for Plug Power shows most inquiries were in mid-January when the prices had already exploded. Those who invested at that time are now facing up to 60% price loss. Surely another hype could come, but generally, if everyone and everything is talking about the stock, I do not want it. That is to say, today I have an idea that I regret to have gone to the pharmacy to buy sleeping pills, then buy first-class German stocks, and set the scale to 97 and sleep. Not worry about the thunderstorm and awaken to good surprises. Rule number 2: buy stocks and take sleeping pills. The interview with André Kostolany was conducted in May 1994, and those who listened to his tips to buy first-class German stocks had amassed a small fortune by 1997, just 3 years later. Looking at the DAX, the German stock index, the price was slightly over 2,000 points in May 1994, and 3 years later, in May 1997, it was at 3,600 points, almost doubling within 3 years. However, this tip was related to the situation at that time. Generally, one should not forget that Kostolany advised selling stocks when something fundamental in the world changes. For example, if a company's technology becomes obsolete and has been replaced by a new one should definitely consider selling that stock and not continue to sleep. A concrete example was Nokia, which missed the transition to smartphones. This rule of buying stocks and taking sleeping pills can be applied today with globally diversified ETFs. Those who have the world index in their portfolio do not need to worry about short-term changes and innovations, as these will be automatically included sooner or later in the ETF portfolio. The risk of individual stocks is generally increasing due to the rapid pace of innovation, and thus, only the world company offers great stability. Moderate inflation is, in fact, a sign of a healthy economy. It encourages spending and investing rather than hoarding money. When prices rise gradually, it incentivizes consumers to purchase goods and services sooner rather than later, which helps keep the economy moving. A controlled level of inflation also allows businesses to plan for the future, knowing that their costs and prices will rise in a predictable manner. So, while high inflation can be problematic, a moderate level is actually beneficial for economic growth and stability. And now we come to Kostolany's most successful speculation, from which rule number 4 derives. I invested in Paris in German bonds issued by the German Reich before 1933, which in the 1920s had collapsed 3 times, sponsored by the Americans and international investors. They stood at 250 in France, 330 nominally worth 1,000 francs, then at 200. How could you, in 1946, entertain the absurd idea that the German Reich or the successor state would ever pay again? I had confidence. I knew Germany not from newspapers but personal knowledge, and I had trust in German discipline and virtues. especially under Chancellor Adenauer, whom I regarded as a god. I told myself everything would be paid, not tomorrow, perhaps in 3 years, but the 1,000 francs are certain. I bought them and recommended them to all my friends, who followed of course, but they sold at 300, bought at 250, the repeated old story. They must have later smiled at this persistent pattern. Buy at 2, sell even earlier. I kept buying and waiting, and then the London debt agreement came, and they balanced the payment. Everything was not determined when and how, but it happened. I bought them in Switzerland, in Paris. Swiss banks gave credit based on them. They laughed naturally at buying German bonds, considering I was crazy. On the stock market, one must say 2 things: fantasy and patience. As Einstein said, imagination is more important than knowledge. My imagination was far-reaching. Germany will rise from the ashes alongside de Gaulle and not default on the debts that were agreed upon. And that's how it was. I received 35,000 for each bond of 1,000 francs, for which I paid 450. This discovery, which economists explained with perplexity, made a 400-fold profit possible. Adenauer, not just a politician but a statesman on par with Churchill, had the vision of Franco-German friendship, and even to Americans, granted back in good dollars borrowed to us and across the nationalities. He was one of those obliging and intuitive generals who saw this through and facilitated my perseverance. Having patience was rewarding. Rule number 4 at the stock market. One needs imagination and patience, and it should be worth it. Yes, imagination is more important than knowledge, as Albert Einstein said. And through patience, it's possible to endure short-term downturns and crashes, just as long as you maintain confidence in your own idea. Rule number 5. People's panic is good business, and it holds truer today than ever. There are crash prophets who market their funds through people's fears, and gold dealers who also profit from the panic of people. At the end of the day, the game with fear is not new and thus as old as humanity itself. We humans react much more strongly to negative news than to positive news, which makes the thrill of anxiety more likely to catch people's attention. The crucial thing is not to let oneself be unsettled by it in one's own investments. If you have further questions about the stock market or general financial questions, feel free to write them in the comments below. If you enjoyed the video, destroy the like button and subscribe to this channel for more tips and tricks around your finances. Up here on the right, you will find my portfolio that I use for long-term investments in stocks, and up here on the left is a video that might be interesting to you. Thank you very much for watching. See you next time.